Disclosure. I think before we go into the detail, just kind of like to summarize what are the key points to keep in mind from a disclosure angle. One is, whatever venture we're entering into, because there's a lot of judgment, what you'll find in your basis of prep, in your notes to accounting policies, we have significant judgments and disclosure. In those, you'll see a lot more disclosure that we're entering into joint ventures or joint operations. What is the real element on that? So you could have lots more judgment that these were the factors, that we've got a board, we've got this is how the judgment is, the operations are structured, and therefore we've decided this to be a joint arrangement or a joint venture. So that's where you really put a lot more disclosure in terms of the arrangement that you have. Secondly, it's kind of saying in terms of disclosure in subsidiaries, interest in unconsolidated structured entities, that is more applicable from a financial services angle, generally speaking. If you've got banking, capital market clients, or asset managers, or insurance companies, that's where you'll find more kind of onerous requirements or assessment. So I'll try not to go into the complexities unless people want me to go into that. Happy to do it. Third, in terms of joint arrangement associates, again, it's all encompassing. It links into the Companies Act also. If you've got related party transactions, how the related party umbrella is being kind of broadened out, all of that will really fit into the disclosures per se. That's the kind of real crux of this. The key difference between Indian GAAP and here, in one word, it's more onerous. So I think that's what the key messages are in terms of disclosure requirements. This is just kind of giving the background that is come out from a financial kind of crisis, where previously entities were not consolidated. They're kind of coming into, users should really understand how the financing happening. Previously what would happen is you'll get all the upside because the funds were coming into the company, but none of the downside was coming. It was to actually showing that we've got those funds off balance sheet. So it's kind of really trying to prevent all of that from happening. It applies to pretty much everything. So subsidiaries, joint arrangements, associates, unconsolidated structured entities. We say unconsolidated, again, you could have financing vehicles, and it's more applicable, as I said, to the financial services sector. But there may be examples where you've got funding structures. So any IBFCs or any other companies, then you've got to be careful of. What it does not apply to, so post-employment benefit plans. So that's excluded from the standard. That's covered by IndAS 19. If an entity's got separate financial statements, then that is, again, not really covered by this, except you've got unconsolidated structured entities. If you've got an interest held by an entity that participated but does not have joint control or significant influence, so unless it kind of really fits into those brackets, it's not really coming, which is more rarer in practice per se. If you've got an interest in another entity, and if you've got, for example, an option or any credit default swaps, so sort of kind of options, they may not really be coming under this standard, and it might be fitting into more into IndAS 39 and 32 classification. This is stating the obvious, that there's a lot of significant judgment in terms of whether an entity has control, joint control, or significant influence over an entity, and what is the type of that joint arrangement. So that disclosure must be kind of included in terms of the nature, the type, when it was created, what's the purpose. All of that would really need to be explained in the accounts. Any significant judgments and assumptions. So if you've got any facts and circumstances that have changed from one year from the other, or during the year, if you're creating a stake in one entity, even though there may be SEBI guidelines on that, just be aware of the wider regulatory framework in terms of how that is being disclosed in the financial statements. Some of the examples. So even though you've got more than 50% of the voting rights in another entity, it may or may not be consolidated. For example, the operations could be governed by somebody else. You may not have the ability to fully direct or change substantively. So if the threshold was 75% rather than 50% in terms of whatever the governance board details are. If the fund manager, for example, cannot be moved in the asset management industry, then again, that's not really being consolidated. So those are some more practical examples we'll try to put in. This is just saying what should really be disclosed, so in terms of the nature, the place of business, profit and loss, any accumulated non-controlling interests, summarized financial information which includes any dividends, so what is really being contributed by that entity. I think this is more straightforward in terms of disclosure.
Point material NCI, this will really be given. It will not be accumulated on a cumulative basis. For each material NCI, you will have to give it separately. So be very careful when this assessment. Therefore, the disclosure will be a lot more elaborate. You need to get all those relevant information which is really there. Okay, even though we will have it by thing, but there are certain information which we are asked for. For all material, each material NCI, you will have to give it separately.
Just talking about the in terms of restrictions on the group. So if you've got significant restrictions, be that to access the assets, or if for matter, if you're not really benefiting, even though you've got a higher interest, then those will need to kind of be considered. Equally, if you've got restrictions on transferring cash within the group, that again might create dividend blocks or otherwise. So that's again something to kind of be aware of, even though you've got a joint operations, or that will kind of really kind of come into consideration. The nature and extent to which protective rights can significantly restrict the ability. So even though you've disclosed everything in the relevant entity, from the entity's perspective, we just need to be wider. That what are the other entities who've got disclosure, because you may not want different disclosures instead of two entities. So are the disclosures being consistent across the market or not? The carrying amount in the consolidated financial statements as to what are the restrictions that apply to it. So if you're going to restricted cash, is that appropriately disclosed or not? Those sort of arrangements just be careful of as to whether the full true and fair disclosure is made or not in the financial statements. Changes in ownership interest without the loss of control and effect on equity attributable to the owners of the parent. That is something that, again, from a disclosure element. Information and consequences of losing control. So what happens if you got a significant operation? What if we're losing control? Are there any triggers or not for that? Are there any adverse events that's taken place during the year? Any gain or loss, if you lose control, has to be recognized in P&L, as we were kind of saying earlier. Whereas if you've got from a 60 to 80%, even though the control is maintained, that's going into reserves. So that's another kind of element, just to reiterate what that slide is trying to portray. What we're also saying is in what line item have certain disclosures been made, that has to be explicitly shown as to the composition of the specific requirements. So from an analyst perspective, companies would prefer to give more onerous disclosure requirements from that angle. Structured entities, I mean, generally what they defined is if you've got any entity which is issuing an equity instrument or anything else, be the warrants and so on, then that's all usually kind of forming part of the entity. Equally, if you've got any dominant factor of control per se, if you've got voting rights which relate to administrative tasks, generally what the structured entities, the features could be that they have very little equity value to that. You could have a lot of funding or contractual arrangements within that structured entity. I would not go into a lot of details per se, because that's a pretty complex area. But do people here, any kind of people here aware of structured entities? Do they have structured entities in their businesses? No? So an example could be, say for example, you've got one entity. That entity wants to raise financing from the market. Now the investor wants to get exposure to any credit risk of another entity. So that entity might issue a credit default swap to that entity in a financial services kind of angle. And the investor puts money into that entity. Now even though the entity doesn't have enough equity and the investor is pumping money into that angle, the investor is benefiting from that structured entity because he's getting exposure by issuance of that credit default swap from that entity. Now equally, you've got a bank which is funding that credit default swap per se. So the investor is getting money, he's getting exposure to that. Now previously you may not be consolidating that because you're getting exposure. You're saying I don't really have any voting rights. All the decision that need to be made was made at inception, because wherever the investments were made through that funding vehicle, that control no longer rests with the investor. But under this new standard, so SPV is very similar to a structured entity as well. So it's all in the same kind of umbrella of various entities. There's no material difference per se in SPVs or structured entities or vehicles. They all, in a way, were these off-balance sheet financing arrangements. Some common features or attributes of structured entities is saying if you've got narrow, well-defined objective, you cannot finance activity without subordinated support, financing to contract linked instruments. These are more kind of complex arrangements per se. Yeah, you've got securitization, asset-backed vehicles, investment funds, all forming part of structured entities. Do people want me to cover this angle, or should I move on? Yeah. This just gives you some. I'll just cover this very briefly in terms of disclosure requirements. So if you've got any unconsolidated subsidiaries, entities now usually give disclosure requirements in terms of, yes, we've got certain assets on our balance sheet, we've given it to another entity, through that we've raised any funding. So you've got any collateralized debt, any commercial mortgage-backed securities, all of that really gets disclosed in the financials now. Previously, it wasn't really happening. And through that disclosure times, we're trying to capture the financing elements of those various mechanisms that are used by entities. If you've got any unconsolidated entities, again, what you'll say is, what is the risk? Now, does the investor have access or obligations which are greater than the benefits it's generating? Equally, if there is something that we were saying earlier, that the entity is generating funds from the market, and if that's not disclosed, or the balance sheet is an off-balance sheet financing mechanism, and that's not really giving the true picture. So but in terms of if you've got a structured entity per se, now if there is no, if it's not been consolidated previously, what we're trying to say is we should at least disclose the nature of that. So what risks are we exposed to? Now you may not really control it. So it may not get consolidated because we may not have access to the voting rights. We may not control the operations of that. All of the relevant activities could be made on day one. Subsequently, we may not have any control of whatever happening in that entity. So you just created a new venture per se. And therefore, we're saying it's unconsolidated. One more example to think of is if you want to raise funds from the market, what will happen is if the new venture has a better credit rating, you may be able to generate funds with a better access or interest rate as opposed to having it part of the same entity. So examples of unconsolidated, I don't think that really kind of matters. Again, it's kind of senior loan rates, interest rate swap, credit default swaps. All of those are kind of unconsolidated because those are more financial instruments per se as opposed to legal entities. That's kind of happening. This is pretty standard again in terms of the disclosure requirements. What's the name of the arrangement? What's the nature of the relationship between the parent and the other kind of companies? What's the principal place of business? Are we using any tax havens or not? What's the proportion of ownership? Who are the other parties who are investing or not? Where are the funds being generated from?
So is an associate also defined, or a joint arrangement is an associate?
So a joint arrangement could be necessary, but generally speaking, if you look at 20 to 50% of voting rights, you could kind of classify that this is more of an associate per se.
So it's defined in the standard?
Yeah, it's defined, yeah.
There is a separate standard.
Yeah.
Okay, there is a separate
I
standard.
studied.
It is significant influence.
Yeah.
Your significant influence.
Okay.
So required disclosures for joint ventures. So if you've got any accounting policy, is it individually material or not? That will need to be disclosed. Whether it's equity, how are we really accounting for it? What's the financial information? The fair value of the quoted market price. Again, if it's individually immaterial, that may not be relevant for disclosure. So there's a bit of judgment in terms of what you want to disclose or not disclose in the financial statements. Equally, if you've got any restrictions on ability to transfer funds, that must be disclosed because that will impact the group working capital per se, potentially. If you've got any commitments, again, that will be disclosed in both scenarios because you could have contingent liabilities associated with that. The group could be exposed to significant risks through that venture or not. If it's ring fence, they may not be required. So I think that judgment needs to be made. But those are just the indicative disclosure requirements in terms of what's needed. Unrecognized commitments, so just contributing funding or resources. So you've got capital intensive projects, loans, financial support, if you're acquiring another party's interest. These are just some of the examples of where additional disclosure may be made. That's just some wording in terms of what example disclosure. So if a group had a commitment, now if you've got capital intensive industries, they might make commitments. Equally, if you've got a fund investing in another fund, they might say we've got a commitment to invest X amount of money into another company. So even though the money is not left the company, you really have a liability that you're going to fund a particular venture for up to a certain amount. So those sort of disclosures need to be captured. This is really saying that what are the key line items from a disclosure perspective that should be made. If you've got subsidiaries and material non-controlling interest, then post-tax. Generally speaking, if you see P&L up to continuing operations is applicable across all, whether it's associate joint ventures or subsidiaries with material kind of elements, where you've got some kind of optionalities in terms of tax elements or not. But what I see in practice is companies have a lot of judgment in terms of how much they want to disclose to investors. Certain companies want to kind of stick to the bare minimum, that we do not want to disclose any more than this. Certain companies will we want to give more voluntary information. And that really depends on company to company. So there isn't like a black and white per se.
So does the standard also prescribe the formats in which this disclosure?
It does include indicative guidance in terms of what are the various line items. Now you could have rows, columns. It's not necessary. As far as the information is there, that's the more important element. I think the key point here, if you've got any material joint ventures, it has to be each material joint venture. It's not a consolidated. So if you're currently combining all JVs into one line or something like that, that doesn't really kind of happen. So you just got to be careful that each of those ventures are separately disclosed per se. And that will be quite an onerous task if people do. I mean, I'm assuming that information should be readily available, because otherwise how are you really consolidating that? But that is just something to be aware of. Immaterial interests, again, disclosure can be made in aggregates, because immaterial, we're just kind of combining everything and showing that. If you're only required, if it's equity method is used, separate presentation of associates and joint ventures, that needs to be kind of taken into account. All amounts in terms of our investors or joint ventures share. So pretty much the key line items in terms of profit contribution, that's the key element that needs to be disclosed in the financial statements. In terms of GAAP, there's no differences between kind of India 1 or 2 and that. I think that's pretty much, yeah.
Which would be the corresponding case 27?
There is no corresponding standard.
There is no corresponding standard.
So I think, see, in nutshell, overall, this may look like a very just routine disclosures, but in real life, I will tell you, it will be a hell of a job to really collate all this information and present it in the financial statements. In fact, measurement, everything you can tackle with disclosures, getting those information, presenting it in a structured way in financial statements requires a very rigorous process, and capturing those information. You need to realign your group reporting packages. You need to maybe have your systems and processes aligned. You need to think from a sensitivities perspective whether we are ready to disclose all those information or not. So a lot of those angles are there. We have just tried to highlight this or the gravity or the amount of disclosures which is really required. But one should really focus on, this is one of, presentation and disclosure is one of the biggest slippages which can happen in a conversion project, whether you are able to give all those disclosures or not. And internal controls around that, of how do you really capture those information really well so that these things are effectively disclosed. It should be a priority area for all of you. So I think the only request will be, even though there is nothing technical to be discussed here, it's more about absorbing what information is there. Giving your time, just flip through this and try to benchmark, are we really giving this information in the current Indian GAAP? And majority of information, I will tell you, except for summarized information, you will not be giving it. And it will require significant rehauling of your systems and processes to capture those information if you want to drive it through systems. or you need to really engage with your associates and JVs especially, so that they can give the information in the manner in which you want. I think that's the only thing which I would like to specifically highlight to all of you. I think anything else more than
Does this require disclosure to be done every quarter?
No.
Quarter.
This is disclosure. If you are preparing, see, in IAS 34 or IndAS 34, if you will be presenting full-fledged IndAS interim financial statement, then yes. If no, otherwise, I don't think in SEBI clause 41, all this information will be mandated every time, unless and until they change the disclosure requirement. At this point in time, nothing on board like that.
It's usually just semi-annual and annual as of now.
Yeah. So thanks
Thank
a lot,
you.
Shafaq,
Thank you.
and we meet on next Saturday.